What's up, traders? Anthony Crudele here, and in today's episode, we're diving deep into the seasonal macro trends with Erik Norland, the senior economist at CME Group. We discuss market reactions to the latest FOMC meeting, explore the current seasonality dynamics of the markets, and assess the potential impact of everything from geopolitical headwinds to the surge in markets following the FOMC meeting and CME's Fedwatch tool projections. As we approach year end, we'll also get Erik's market outlook for 2024 and what traders and investors should expect from markets in an election year. Don't miss this concise but comprehensive overview of the key elements shaping the current and future state of financial markets. Today's podcast is brought to you by CME Group. Whatever the obstacles, CME Group provides the tools that global market participants need to manage risk and capture opportunities. With 24-hour access to futures, options, cash, and OTC products across all major asset classes, you can drive your trading strategy forward with confidence and precision. CME Group, where risk meets opportunity. Erik, welcome back to the show.
Thank you so much for having me.
Perfect time of the year to have you. The FOMC just held its final meeting of the year. Interest rates remained unchanged for the third time in a row. Inflation has eased but remains high. Powell believes no recession and a soft landing is possible. A dot plot shows 3 rate cuts in 2024. The Fed also acknowledges that inflation's eased and tempered rate hikes. Equities rallied across the board, as we all saw. Russell 2000 up the most, really playing catch up at the end of the year to the rest of the indexes. Gold was up, bonds were up, even oil was up, and that followed through the next day of trading as well. What I thought was really interesting is the CME Fedwatch tool, because I like to go to that immediately following these Fed meetings to see what Fed funds are pricing in. And it suggested the possibility of 6 rate cuts next year. And I think that probably an overreaction. We'll see what you think. You know, obviously Powell had this dovish shift, but overall, I kind of laid out there what I think is really like the key takeaways from the FOMC meeting and Powell's statement. But what did you make of this final FOMC meeting of 2023?
Well, I think it was fascinating. I mean, it didn't surprise me that they kept rates on hold, but the dot plot and the aggressiveness with which the Fed thinks it's going to be cutting next year was a major shift. And that really caught the bond market by surprise and created this gigantic rally across the entire yield curve. It is now spread worldwide, and as you mentioned, it's also spilled over almost immediately into the equity market, which continues to rally as we record. Yeah, so it was in some ways a big surprise that the Fed is thinking about cutting as quickly as it is. And it's a sign that the Fed has now sort of joined the market in assessing that the Fed is probably over-tightened policy. You know, they did 525 basis points of rate hikes, the most that they had done since 1981. Inflation, as you mentioned, has come way down, especially outside of this owner's equivalent rent. Inflation's back down to 2%. The data continues to be quite strong. Employment, retail sales, very strong in the last few days. But the Fed clearly thinking about cutting, and the market thinks they're going to do even more.
What I thought was very interesting is you talked about the dot plot, and it really showed 3 cuts next year. Am I correct in that, Erik?
Yeah, that's what the dot plot showed. And that's sort of the Fed's belief about what it's most likely to do. And of course, there's a variety of beliefs among the different members, but this is sort of the average belief.
But then you go to the CME Fedwatch tool, and I think maybe you touch base real quick about how that works. And it actually shows 6. And like I said in my opening statement, I really think that's an overreaction because obviously with the moves that you're seeing in treasuries and bonds and Fed fund futures, that's obviously going to price that in. And of course, the Fedwatch tool isn't perfect, but when you got a reaction like we did in the marketplace, and you see the dovishness that Fed Powell talked about, people are racing in. And so then I think a lot of times you will see that, expand into the markets, and it might be an overshoot, but it's really kind of interesting to see how aggressive treasuries and how aggressive even Fed funds are to show 6 rate cuts next year.
Yeah, well, 6 rate cuts, if it happened, would bring us down to 3 7/8% rates, so between 3.75 and 4% rates. You have to bear in mind that as recently as the beginning of May, so like 7.5 months ago, the market was thinking that the Fed was not going to be at 3.78 at the end of next year. The market was pricing the Fed was going to be at 3%.
Yeah.
Yeah, the market in May thought the Fed was going to raise rates up to around 5 or so. The Fed actually raised a little more than the market thought. And then it thought the Fed was going to slash rates to like 275, 3. So we're actually only partway back to where we were in May. And this move has a lot of momentum behind it. So 6 rate cuts expectation might sound like a lot, but it could potentially go even further and then at some point bounce back. We have seen incredible volatility in short-term rate expectations now in the U.S. for the past 2 years. We had a massive sell-off in the short end of the yield curve, meaning yields were soaring up until November last year. Then they plunged into May. Then they soared over the summer, peaked out in early November. Now they're plunging again in terms of where people think rates are going to be. This is going to remain very volatile and very unsettled, but I think we're perhaps only partway through a much bigger move.
No doubt. I mean, I think that this latest Fed meeting sets the table for a very, very busy year across all markets in 2024, which I mean, as a trader, I mean, it's exciting. But, when I look at things right now, it's one of those things where I look at, is this really just an overreaction right now? Or do you think that the market's reaction is in line with what just happened?
So, I think in some ways, I'm more on the view that the market's reaction is in line. And there's 2 reasons why I think this. First, we have had an extraordinarily inverted yield curve in the United States for over 12 months now. The steepest inversion between short-term and long-term interest rates that we have seen in the US since the early 1980s. I should say in my experience, not really my experience, what the data suggests going back for the last 40 years is that yield curve inversions are actually very highly correlated with economic downturns that happen about 2 years later. So the bond market has basically been warning the Fed for a long time that the Fed may be over tightening and may be at risk of generating a recession. In the meantime, we continue to have strong economic data, just like we had in '89 when the Fed inverted the yield curve, just like we had in '99 when the Fed inverted the yield curve, just like we had in 2006 and early 2007 when the Fed inverted the yield curve. The incoming data remains strong. In all 3 of those cases, the economy wound up falling into recession, but the recession wasn't in '89, it was in 1991. It wasn't in '99, it was in 2001. It wasn't in 2006 or early 2007. It was really in 2008 and 2009 that the main downturn came. So the bond market's been sending very, very clear warnings that the Fed and other central banks may have gone too far in their hiking. But at the same time, complementing that, you have a collapse of inflation rates. The U.S. core inflation rate on the core CPI is 4% year on year, which, as you mentioned correctly, is a bit high, much higher than the Fed would like. But if you take that and you break it into 2 parts, you break it into a first 6 months, so from like December to May, and a second 6 months from June to November. The first 6 months, it was at 5% annualized. Second 6 months, it was at 3% annualized. So the trend in inflation is very steeply downwards. And then if you get rid of this whole component called owner's equivalent rent, which assumes people rent houses from themselves, which, by the way, they don't do, inflation is really running at 2% or 1.5%. So, I think that this is a real move. I think it's got real economic logic behind it. But what's going to challenge it is that the incoming data could remain strong for quite some time. We just got strong employment. Today, we just got strong retail sales. There's going to be some resistance to this move from people who are saying, hey, look, right now, the economy is still doing pretty well.
I want to talk about inflation just for a moment because when you talk to traders, they'll say, yeah, inflation is heading in the right direction, but there's still a lot of inflation out there. When you talk to mainstream people, my friends that aren't in the market, they'll all tell you that they think inflation is still as high as it's ever been. How is the Fed tracking inflation? I think most people that are in the business understand that, but I want to get beyond that. How are they tracking that? And how do the mainstream people really look at this and say inflation isn't coming down, but yet some of the data says that it is?
Yeah, so let's talk about the second part first. The second part, Church, I think is fascinating. And look, ultimately, we're all part of the mainstream, right? Like we all go to stores and we all buy stuff and we all experience the level of prices. But what we experience as consumers is really the level of prices. And so when people are saying, well, inflation's still really high, what they're saying is prices are still really high. Prices are not coming down. they are coming down for a few things. They're coming down for like used cars. They're coming down for airfares, coming down a little bit for oil and natural gas finally. But, in general, when you go to stores, everything's still very expensive. So people don't feel like inflation's readjusting to where it was in like 2019 or 2020. When economists measure inflation, particularly in central banks, they measure the year-on-year change of inflation. And then there's a whole bunch of debate. So the Fed's really looking, I think, at 4 different inflation measures. It does look at headline CPI, which is a very volatile, it has food and energy and all sorts of other stuff. It looks at core CPI, which excludes food and energy. It looks at the so-called super core CPI, which excludes food, energy, and owner's equivalent rent. That's the one that I mentioned earlier. It's running at 2%. And then finally, the Fed has a favorite measure of inflation that's calculated by a separate survey, a much more detailed survey that is used to calculate the GDP deflator, which is what sort of takes nominal GDP and inflation adjusted into real GDP. And so there's a component of that comes out monthly called the personal consumption expenditures inflation measure. And so they look at the core PCE, so that excluding food and energy. And that's also showing like 3.5% to 4% inflation. So the Fed's looking at all these measures. I think they look at it very comprehensively, but they're looking at rates of change, whereas we as consumers are experiencing price levels.
Got it. No, thank you for explaining that. I think it's so important for people to understand that. Next thing I want to talk about is really what a lot of people would say is that Powell's really done a 180. He was really holding the line higher for longer. We're going to look at the data to now turning dovish. A lot of people are saying maybe something's broken. Maybe they see something that we don't. What do you say about that?
Well, I think that the Fed is trying to look ahead, and they're seeing that inflation rates are coming down. They're seeing that some economic indicators are a little bit on the soft side, especially like in the housing sector, housing construction. And so I think they're thinking about, readjusting monetary policies. They're expecting a soft landing. So even during soft landings, like we had one, most famous one and the best one might have been the one in 95, 96. The Fed cut rates by 75 basis points and they had hiked rates by 300 in 1994. Then they cut rates back 75 basis points in 95. And the market loved it. The S&P was up 35% that year. So, I think that the Fed is probably maybe also concerned. I think the bond market is concerned that something is going to break. You're going to see, maybe like lots of defaults on commercial loans, commercial property loans, or something's going to go very badly wrong. We haven't really seen that happen yet on a large scale. We've seen little isolated things here and there.
Let's talk about seasonality. I mean, we're in December and everyone's talking about the Santa rally. I think we got a big enough rally at this point, Erik. But when you look at everything now, let's even take it beyond the Fed. Let's look at seasonality. Let's look at where we are. Are you seeing any significantly bullish or even bearish, God forbid we even say bearish right now with anything, macro signals?
Yeah, so I think that the bearish macro signal is really the inverted yield curve. And again, it's a leading indicator that's pretty far out. It probably has its peak influence about 2 years away from the actual event. There have been a lot of isolated areas of weakness in the economy. Mortgage rates went from 3% to 8% at their peak. That has definitely put a dent in the housing market. It's not that house prices are falling like they were before the global financial crisis. That's not the case. It's more they've stopped increasing and housing construction has trailed off. There are some enterprises here and there who have excessive levels of debt who have suffered a bit under the higher interest rates. And I think a lot of small businesses in particular are suffering because of higher financing costs. So there are some areas of softness. But I think for the moment, the incoming data still looks pretty strong.
Yeah, no doubt. And I want to take that and really bring you into the divergence that we had seen all year long between the Dow, S&P, NASDAQ, and Russell, right? We had a year that tech has led, S&P kind of in the middle, and then you had Russell and Dow really not participating. That has really shifted. I mean, Russell had the biggest rally yesterday. Dow, if you look at that on a chart over the last month, has really outperformed NASDAQ and S&P. So Russell, small caps, and Dow have really come on as of late. How do you interpret that action?
So Russell really suffered very badly as interest rates were going up, whereas the Nasdaq did not, and the S&P didn't particularly suffer either. So what's going on here is the companies in the Nasdaq are big tech companies. They have very little debt, and they have tons of cash. They're just sitting on piles and piles of cash. So when interest rates went up, all these cash reserves that they have suddenly earning interest, like some 5% interest rates. It was great for them. The S&P 500 companies, which include a lot of tech companies but are more diverse, these are huge companies, and a lot of them very wisely issued debt during the pandemic when long-term interest rates were being held very low by the Fed's QE program. So a lot of them locked in low long-term financing. So for them, it didn't really matter when rates went up. In fact, this is kind of arcane, but if you issue a long-term bond and you're the issuer and the yield on that bond goes up, the liability actually shrinks in your balance sheet. So a lot of companies actually saw shrinking liabilities. You see, when bond yields go up, the prices go down. And so if you're the issuer of a bond, you're essentially short the bond, so your liability is shrinking. Small businesses and mid-sized businesses like those in the Russell 2000, a completely different story. Small businesses or mid-sized businesses like those in the Russell 2000, by definition, almost never issue bonds in the bond market. They're just not big enough to generate the interest. They borrow money from banks, and the average length of a bank loan for them is 2 years. So they're much more sensitive to the state of short-term interest rates. So for them, it was a nightmare when the Fed was increasing, and it is just amazing if the Fed starts cutting. So that's why we've seen these huge rallies, including I think up 5.5% day in the Russell in November, followed by another massive rally over the last couple of days, all as these interest rate expectations shift. So different companies and different indices respond to rates in very, very different ways.
Yeah, it's incredible. I was looking at the Russell this morning. I think it's up over 5% in just the last 24 hours.
Yeah, it's incredible what it's done.
It's a huge move for an index. I mean, you don't see that too often. Next thing I want to talk about is gold and cryptocurrencies. I'm putting those two together really just because Bitcoin really talked about in really the same respect as gold these days. Maybe we'll get your thoughts on that. But I really want to get your thoughts on the rally that we saw in gold and Bitcoin following the Fed as well. They had both really been kind of underway with a rally anyway, but you see massive moves in those markets as well. It's really turned into almost the buy everything now after this latest Powell statement and FOMC meeting. Thoughts on gold and Bitcoin?
Yeah, so gold and also silver respond very, very well to the prospect of possibly lower Fed rates. So gold is basically like a currency that pays zero interest. You could make the same argument for silver too. So when the Fed started raising rates, raised rates 500 basis points, it basically prevented gold from rallying. So gold's supposed to be an inflation hedge. We had soaring inflation hedge. Gold basically traded sideways for 3.5 years. Now that the Fed is maybe starting to get ready to cut, and people certainly expect it to cut a lot, gold is now toying with its record high. It actually pierced it a few weeks ago briefly. Intraday sold off a bit, and now it's coming back. Silver had an up 6% day. Now, Bitcoin and gold are often mentioned in the same breath, but I think they're quite different. Bitcoin, I think, has been rallying for reasons that don't have so much to do with rates. Bitcoin's correlation with rate expectations is not very high, unlike gold. Bitcoin, I think, has been rallying because of the prospect of more Bitcoin ETFs. What Bitcoin actually correlates with positively is actually the Nasdaq. Bitcoin has very little correlation day to day with gold, but it does typically correlate somewhat with the Nasdaq index. So people see it as a bit of a proxy for tech stocks. Tech stocks, like most other stocks, have reacted positively to the prospects of easier monetary policy.
Yeah, that makes sense because Bitcoin, it's technology. And when you look at the younger generation, that's what they look towards. And, they're going to be using Bitcoin, whether people of my generation or older want to believe that or not. Bitcoin it's what they think of. I mean, I talked to a lot of people a decade younger than me and beyond, and they really believe in crypto. And so I think that when you think about that versus the NASDAQ in terms of correlation, it makes sense just because I think more of a technology play. Is that really what it is, Erik, the technology side of things?
Yeah, I think it is, as you mentioned, generational. Bitcoin, I think, is here to stay, at least for a long time. In some ways, it is a very unusual asset, and it does have certain gold-like characteristics, which makes Bitcoin really unusual. Almost like an extreme version of gold is it is limited to only 21 million coins that will ever
Yeah.
exist. And we've already created, I think, over 19 million of those coins. So the remaining less than 2 million coins are going to be created between now and the year 2140. According to the Bitcoin algorithm. So it's just a very, very unusual asset, but because its supply is so limited and because people are willing to pay for it, it has value. And that, so long as the community around Bitcoin it likes to trade it, believes it has value, it will continue to have value in the marketplace.
Yeah, well said. As we wrap up 2023, what a year it was. Let's face it, if we all went back to the beginning of 2023, did anyone have this in their cards, what this year was? I would say most likely not. I mean, this year has been, wow, what a year. It's hard to even imagine that we're at all-time highs in indexes after what we saw last year. But nonetheless, we are here. Next year is interesting because it's an election year. We've got majority of the news behind us. Obviously, we're only down to a couple weeks left in the year. What is your outlook on 2024?
That's a really tough one. I think that 2024 will be the year that we experience the economic consequences of the biggest worldwide rate hike since 1981. Yeah, the Fed did 525 basis points. They only finished raising rates 5 months ago in July. So this is all very fresh. They're not the only ones. Essentially, every central bank you can name, except the Bank of Japan and the People's Bank of China, all did massive, massive rate hikes. It takes a long time for those rate hikes to feed their way through the economy. But in 2024, the rate hike chickens are going to come home to roost. And we're going to see what the consequences will be for the economy.
Yeah, I mean, it's really incredible how we're ending this year. I mean, you go, like I said, you go back to the beginning of 23 where we were and all the talk up until this point. This has really jarred markets. I think that this really is going to make for an exciting 2024. I'm a really short-term trader and I'm super excited about the opportunities that this is going to provide, I think, across all markets. I mean, we didn't even talk about commodities really much today, Erik. I think they're going to be an interesting play next year as well. Election year, I guess really we leave on that. I mean, historically, I know you're somebody who follows history a lot when it comes to markets. What is something that we typically see over the course of time in an election year?
So, to me, the biggest result of the previous two elections was two things. First, when you look at 2016, you look at 2020, the market showed very little reaction until the day or the night of the election and the days after the election. Yes, it was very unclear what the impact was, going into November 2016 and November 2020. After the election results became known, we saw two things. We saw both huge equity rallies and huge sell-offs in the bond market. But that may have been a special case because even though the 2016 election and 2020 election in some ways were opposite elections, right? Like one party won everything in 2016, the other party won everything in 2020. They had that one similarity. One party won everything. And when one party has unified control of the White House, the House, and the Senate, that means they can get their agenda through, which is often fiscally expansionary. Could mean tax cuts, could mean spending increases, but it means action towards bigger deficits, towards more economic stimulus. And the equity market liked that in the last two elections, and the bond market was not so keen on it. This time, we have no idea what's going to happen in this election. We don't know if it's going to result in a unified government. We have no clarity, but it might be like 2016 and 2020 in the sense that the market reaction comes after the election results become known and not before.
Yeah, well, that's going to be exciting. Erik, it's always a pleasure to speak with you. Your insights are fantastic. And I just love the way that you talk to us traders. You explain things in a way that we could comprehend, understand, and go back to our strategies and find ways to put the macro in play. So I appreciate you a lot, my friend. I want to wish you a very Merry Christmas, Happy Holidays, and a wonderful New Year.
Yeah, Merry Christmas and Happy 2024. Hope you have a great year and look forward to seeing you next year.
You as well, my friend. Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.